Looking for a fast-charging, ultra-responsive stylus for your iPad? Meet the 2X Fast Charge Active Stylus Pen, designed for 2018 to 2025 Apple iPads. Take your creativity and productivity to the next level. Click the link in the video description to shop now on Amazon.
Hello and welcome to Qualcomm Pulse, your source for the latest insights on the world's top tech companies. Today, we're going to talk about a stock that's been under pressure lately, Qualcomm Inc. Now, you might be thinking, what's the big deal? It's just another chip maker. But let me tell you, this company has been making headlines for all the wrong reasons. After months of selling off, Qualcomm's shares finally cracked and fell below $150. That's right, folks. The stock that was once considered a safe haven in the tech world is now trading at fresh multi-month lows. And if you thought it couldn't get any worse, it just did. But here's the thing, even in the midst of chaos, there are signs that the tide may soon turn. And one key technical indicator is flashing a signal that should be on every trader's radar, Qualcomm's Relative Strength Index, or RSI. Now, you might not know much about RSI, but it's a simple yet powerful tool that measures the speed and magnitude of recent price movements to identify whether a stock is overbought or oversold. And right now, Qualcomm's RSI reading is sitting at 25 deep into oversold territory. That means the intense selling pressure may soon be reaching an exhaustion point. But what makes this particularly interesting is the historical precedent. The last time Qualcomm's RSI dropped this low was in October 2021. What happened next? The stock rallied a whopping 55% in the following months. Now, we're not saying history will repeat itself, but in markets like these, patterns like that deserve a closer look. And then there's the management team at Qualcomm. Despite the share price being under pressure, they're clearly feeling confident about the company's trajectory. Last month, they raised their dividend, one of the strongest signals a company can send to the market. A dividend hike isn't just about returning capital to shareholders, it's a public commitment to future cash flow. Now, if there's any risk that Qualcomm won't be able to maintain this higher payout, you can bet they wouldn't make the move without good reason. That decision suggests the company sees its earnings remaining strong over the coming quarters. And with solid results in their last earnings print, the pieces are starting to fall into place for a sentiment reversal. All eyes are now on Qualcomm's next earnings report at the end of the month. If they can deliver another clean set of numbers, the current sell-off could quickly look like a serious overreaction. Until then, every session is worth watching. Monday's price action was particularly telling. Despite the early plunge, Qualcomm bounced more than 13% off the lows before the close. That kind of reversal intraday signals there's demand waiting in the wings, especially at these levels. Now, I know some of you might be thinking, what about the S&P 500? Won't that just pull Qualcomm down further? But here's the thing. With technical indicators suggesting the stock is overly stretched to the downside, while fundamental signals like this dividend hike show internal confidence, the risk-reward is shifting. So what does it all mean for investors like you? Well, Qualcomm's chart looks ugly, but not without promise. An RSI reading of 25 combined with a strong dividend move and signs of demand at the lows offers a compelling setup for those willing to step in early. With earnings around the corner, the next few weeks could decide whether this is just a pause in the downtrend or the beginning of a powerful comeback. That's all for today's episode of Qualcomm Pulse. If you're looking for more insights like this, be sure to subscribe and hit that notification bell. And if you're ready to get ahead of the curve, check out our latest research report on the top stocks to buy now, only available on our website.